Hi, welcome to my channel. My name is Gil Rossi, investor and funds manager. Today I want to share with you my review of Amazon after the company reported third quarter results. So let's get to it. So let's go to the investor relations page and check the quarterly results. I'm going to use this information. And let's start with the presentation. In the presentation, I'm going to start with the sales. We see that on a quarterly basis, 110 billion they produced for 2021 and 96 billion in sales in 2020. This means 15% on a year-on-year basis. This may look like a small number for what they have been experiencing before, but let's check the previous year, and we see that this 96 billion, which is the one we're comparing with now, grew 37% on a year-on-year basis from 69.9. So this 15% is the growth over already a very strong number. And if you see, this happened in the third quarter of 2020, which was in the middle of the pandemic, when people was buying online due to the restrictions of COVID. And on top of this, they are now growing 15%. And this is in a world with less restrictions. So I see this number really as really very strong. If we compare this 110 with this 69.9 or 70, on a 2-year basis, they have been growing at a 25.8%. And if we compare that with the previous 2 years, so the third quarter of 19 to the third quarter of 17, these two numbers, they were growing pre-pandemic on a 2-year basis at 26%. So they have kept the growth roughly the same. In a trailing 12-month basis, the growth was 32%, which is really strong, I think. They are guiding that the fourth quarter is going to be around 130 or 140. So if we assume 130, in the fourth quarter, they are going to produce 462 billion sales. And if we compare that with this number, the fourth quarter of 2020, that would mean a 20% growth. So the sales, of course, are decelerating on a trailing 12-month basis. This is what I am assuming in my model, or what I was assuming in my model, so I'm not going to change it. If we now go to the operating income, we see a 22% decline from 6 billion in third quarter of 2020 to 5 billion roughly. And they are guiding between 0 and 3 billion for the fourth quarter of 2021. So the pressure on operating income will persist in the fourth quarter as well. And we will analyze this, whether there's any problem with Amazon or is it something external. So these are the main points discussed by the CFO in the conference call that will help us understand, I think, what's happening. They are on track to double the fulfillment network by early 2020, 2 years after the pandemic. Double the operation capacity in 2 years. This means a high level of investment. They have incurred additional COVID-related costs, and I think these are not permanent, at least partly. They have increased the global headcount by 628,000 employees over the 18 months period, and planning to increase 150,000 more in the fourth quarter in the US alone. So this talks about the level of growth that the company is experiencing. There's a shortage of workers. That means increased wages and signing incentives. They expect 50% of this to be transitory. In the third quarter, labor became the main capacity constraint. So operations were disrupted and led to loss of productivity. They think that they will rectify this by 2022. The disruption in the supply chain plus inflation in the cost of materials like steel or services like trucking meant increased costs of operations. The cost of labor that we mentioned here, the loss of productivity mentioned here, and the cost inflation mentioned here, all of that represented 2 billion extra costs for the third quarter, and they are expecting that this will be 4 billion in the fourth quarter. Extra digital media content costs in video, music, games, etc. for the fourth quarter will be 1 billion compared to last year, and this is to improve the benefits to Prime. So I think that this is an investment in retaining customers and attracting them. Fulfillment capacity is now back to normal. The capacity was running 100% for the previous 12 months, and that of course resulted in an improvement in margins above normal. They expect that the lower cost leverage in fulfillment network for the fourth quarter, and that will have an impact of 1 billion roughly. So they are not going to run at 100% capacity, of course, so that the margins will come back to normal, and this will be a 1 billion impact they are assuming. Then in the third quarter they finally are unconstrained in capacity. This is related to this, and to illustrate, 100 new buildings in the US in September alone were built. So in terms of fulfillment centers, storage centers, and last mile distribution stations. Well, AWS and advertising are the fast growing areas with strong profitability profiles, and they are bullish on the retail business. Between advertising, Prime, fulfillment by Amazon, all are part of the return on investment capital flywheel, and this is the network effect I talk about in my other videos. And Amazon is acting as the shock absorber of costs. So it's not trying to pass these extra costs to consumers, and they will improve the cost structure over the long term, but for the time being they are investing in attracting and retaining customers and providing the best service possible. So if we go back to the operating income, we see what we illustrated before, but if we now adjust this by 5 billion, which is what I mentioned, the 4 billion due to cost and labor productivity and cost inflation, and cost leverage in fulfillment coming from 100% capacity to some more normal levels of 1 billion. So the two of them add 5 billion, and if we adjust that, the operating income would be between 8 and 5 billion and not between 0 and 3. So this is just to show that these are external factors, and the company itself would be running at this level if it were not because of these external factors. So it's just to show that the company itself is working fine. If we see it on a trailing 12-month basis, and we do the same, we assume 3 billion for the fourth quarter, this would be the level of operating income, and if we compare that with the previous year, it's just a 7% growth compared to 42% growth here, so a big deceleration. If we make the adjustment again, that becomes a 30% growth, so still a deceleration, even though taking into account the external factors. But part of this, I think, is the big investments that they are making. They are doubling the network in just 2 years. That's really big. We'll see the investments that they are making in the free cash flow when we check the cash flow. Let me show you this table with the income statement for the 3 months ended September 30 for the last 4 years. And I have calculated here on a total revenues basis, and there's a couple of things here to show. If you see, cost of sales is improving. Fulfillment, we can see that it was constant, but it's going up 17% instead of 15%. So this is how the investment that they are making is also going into the income statement. Technology and content, and mainly content here, is also 11 to 13, and it's even higher than before. Marketing, it's also increasing, and well, we can see that the operating income is fluctuating between 7, 5, 6, 4. So these are the normal fluctuations, I think, due to the big investments that the company is making in keeping up with the growth. So this, I think, is nothing to worry. If we go to the free cash flow, we see a big decline, 91% on a trailing 12 months basis from the past year. So this may look worrying, but let's dig a little bit more. If we check this same graph, but we go 4 quarters into the past, and we see this is the free cash flow. It was growing nicely and now it's coming down, but the operating cash flow has been declining, but not as much as this. So these bars here, the difference between operating cash flow and free cash flow is the investment that they are making. And if you see, if we show this investment in green, we see that, for example, in third quarter 2020 it was 25 billion and now it's 52 billion, so it's 100%. This is due to what we mentioned, doubling the fulfillment network over the 2 years. So this is a big investment that they are making, and of course is hurting, let's say, the free cash flow. But I'm not too worried, because a company that invests at a good return on invested capital, the more they invest, the better. Let's check what's going on with the operating income. If we see here the operating income, in this table, 12 months ended September 30, 2021 and 2020, and this is the operating income, 54 and 55. It declined 1% on a year-on-year basis. But if we check this starts from the net income. The net income went up 51%, while the operating cash flow is coming down 1%. So the main reason here of this discrepancy is, to me, what's happening with receivables and payables. The way the accounts receivable and accounts payable are contributing to the operating cash flow. The two of them here added roughly 7 billion, and the two of them here subtracted 7 billion. So there's a big discrepancy here. If we see on a graphical form, this blue line is the change in trade and other receivables. So the receivables increase as the volume, let's say, as the sales increase, and this one is the change in payables. Also, this is for the past 10 years. So the change in payables also is increasing as the business increases, but there's a big increase here and then a big drop here. So there must something happen in these two last years that make the combined effect of trade receivables and the payables to be, instead of be roughly 3 billion or similar, to be 15 billion in the December 2020 year, and 7 billion negative in the September 2020. This is on a trailing 12-month period. So this big discrepancy, if it hadn't occurred, this difference wouldn't be that bad. So it would be more in line with what's happening in the net income. And if we go to the 3 months ended September 30, we see that the main driver of this decline, this 39% decline, or from 11 to 7, the main driver is this one, the 50% decline in net income, which we discussed. It was mainly due to external factors and also due to the investments. So I am not yet worried about this. In terms of segment results, net sales went up 10% in North America, and this is a number that may seem very low, but again, remember that this number, 59 billion, which is the basis for this 10% growth, was coming from a 39% growth in the middle of the pandemic. So it's a 10% growth over a very strong number. If we go to the segment results in international, they were making a profit, and now they are making a loss. And this loss, the CFO explains that all these positives that we saw here, if we see the previous year here, it's due to the faster volume growth on top of the same cost structure. So similar to what we were talking about before, the business running at 100% of capacity. Of course, when you run at 100% capacity, your cost structure is much better, but of course it's not the best way to run a business, because you have little flexibility. And well, the last segment that they show is AWS, which is showing great growth in sales and in operating income. Let me show you a couple of things here in supplemental financial information. And they open online store, physical stores, third-party seller, subscription, AWS and other in sales. And we see the online stores decelerating to 3%, while physical stores are accelerating from negative growth. Third-party sellers are growing quite fast, even though there's a deceleration as well, but the growth of third-party is much higher than the growth of online stores. This is good, because that means that the proposition that Amazon is offering to third parties is enticing to them. In subscription services, the growth is quite large as well. AWS, we saw it's been accelerating, and this other is advertising, which is also showing a nice growth. And then let me show you one thing here with paid units, worldwide paid units. It grew 46% on a year-on-year basis in the third quarter, and on top of that it grew 8%. So all in all, it grew 58% in the last 2 years. And remember, we mentioned that the network for fulfillment grew 100%, so it doubled in this same period. So even the paid units are growing at the 60%. They are increasing their capacity faster. This is mainly part of it is to catch up for the big sales, as we mentioned, and reducing the 100% capacity to more normal levels. And another is to prepare for the holiday season. So if you see, they say that the inventory in cubic volume is up 40% in the last year. So even paid units has grown 8%, inventory has grown 40%. Part of it is to avoid all the constraints that are going to happen or that are happening in the world, and they don't want to be caught, let's say, not being able to respond to the high demand from customers. So we can see that the company is really making efforts to invest as much as possible in the business and keep up with the demand, which is good. So all in all, I'm not changing that much the model, and for me, it's still the company. If we buy it at today's price, or the 29th of October, it would be a very good return. So I could even go to purchase it at 4,200, 4,300, and I'll still be getting above 10% return. So this would be still the fair value to me of the company. Okay, that's all. I hope you liked the video. Like and subscribe, and thanks very much for watching. I see you in the next video very soon. Thanks. Bye bye.